Has the Federal Reserve just fired the starting gun for the next major leg up in the crypto market? With one single decision, they may have unlocked a wave of liquidity that could send Bitcoin to prices that seemed unimaginable just a few months ago. But what if I also told you that buried deep within that same decision are the seeds of a potential market crash? A scenario that could invalidate the entire bull case and send risk assets spiraling. My name is Nick, and if you hold crypto, you can't miss this vid. First up though, let me make one thing clear. I am not a financial advisor, and nothing in this video should be considered financial advice. This is purely educational content meant to inform you about the latest macroeconomic developments and their potential impact on the crypto market. So, if that sounds good, hit those like and subscribe buttons, smash that notification bell, and let's get into it. Now, to understand where we're going, you first need to understand what just happened. On September 17th, the Federal Reserve's Open Market Committee, or FOMC, did what the market had been anticipating for months. They cut US interest rates by 25 basis points, lowering the federal funds rate to a new range of 4% to 4.25%. And this was the first rate cut of 2025, and it marked a significant pivot from the holding pattern that the Fed had been in. But as always, the devil is in the details. For one thing, the vote was not unanimous. It came in at 11-1 with a single dissenting vote coming from the newest member of the board, Governor Stephen Moran. His dissent was notable because he wasn't arguing for a hold. He was arguing for a more aggressive 50 basis point cut, signaling a growing dovish pressure from within the Fed itself. Then came the press conference itself with Fed Chair Jerome Powell, and this is where the nuance really comes into play. Powell was careful to frame this decision not as a response to a failing economy, but as what he called a, quote, risk management cut. His comments reveal that the Fed is walking a tightrope. On the one hand, he pointed to a softening labor market, noting that, quote, job gains have slowed and, quote, downside risk to employments have risen. On the other hand, he acknowledged that inflation is, quote, moved up and remains somewhat elevated. And this is the classic stagflationary combo that central banks dread, and it's the core conflict that will dominate policy for the rest of the year. But perhaps the most important piece of the puzzle came from the Fed's updated dot plot. Now, for those unfamiliar, the dot plot is an anonymous survey of where each of the 19 Fed officials sees interest rates going in the future. It's basically the Fed's own forecast. And the September dot plot was crystal clear. The median projections showed 2 more 25 basis point cuts are expected before the end of 2025. However, even here there was a bit of a disagreement. 10 officials saw 2 more rate cuts, while 9 officials saw only 1 more, meaning the consensus is fragile. So, how did the markets react to this news? Well, in a word, volatility. It was a classic knee-jerk reaction across all asset classes. In traditional markets, US stocks whipsawed. The Dow Jones actually finished up, but the tech-heavy Nasdaq and the S&P 500 both dropped. It was a perfect illustration of a market struggling to digest the news. Meanwhile, gold, the traditional inflation hedge, surged towards record highs, tapping nearly $3,700 an ounce as investors priced in lower real yields. And what about crypto? Well, Bitcoin's price action was a textbook example of a volatile news event. It initially spiked, then dropped, then chopped sideways, ultimately finishing the day just down under 1%. And it's currently trading at close to $118,000, which is a key level. Okay, so that's the immediate reaction, but the real question is, what does this signal for the final quarter of the year? Well, the Fed's dot plot gives us their view, 2 more rate cuts. But the market is even more convinced. According to the CME Group's Fed Watch tool, which measures market-based probabilities, traders are now pricing in a greater than 70% chance of cuts at both the October and December meetings. In the market's view, the easing cycle has begun and the Fed is going to follow through. The big banks, however, are not in complete agreement. Goldman Sachs is aligned with the market, penciling in cuts for October and December. But Bank of America has warned that the Fed may not cut again until 2026, fearing that cutting into a stagflationary environment is dangerous. And this divergence of opinion from the smartest minds on Wall Street tells you one thing. uncertainty remains incredibly high. The Fed is truly data-dependent, caught between its dual mandate of maximum employment and price stability. And right now, both are flashing warning signs, and things are about to get volatile. And if you want to take advantage of this volatility, then you have to check out the Coin Bureau deals page. That's where you will find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and deposit cashbacks of up to 75% on the best crypto exchanges around. To get these goodies, all you need to do is hit the link in the description or scan this QR code. Once you get on the deals page, find a deal that suits you and click on the Sign Up Now button. Now, these deals, they won't be around for long, and they are only available to Coin Bureau viewers. So take advantage of them ASAP. Back to the video. So, with the stage set, let's get to the most important question. What does all of this mean for the crypto market going forward? Well, the consensus bull case is straightforward and is built on a few strong pillars. First, and most simply, is the liquidity argument. Historically, Federal Reserve rate cuts have weakened the US dollar. When the return on holding cash goes down, capital seeks out other stores of value, and this drives demand for scarce, non-yielding assets, and there is no scarcer digital asset than Bitcoin. And this isn't just a theory. We saw this play out during the 2020 to 2021 easing cycle, where Bitcoin surged over 1,000%. Second, this time is truly different because of institutional firepower. The US spot Bitcoin ETFs are seeing a return in net inflows after a brief lull, and recent filings show that major players like Goldman Sachs are now among the largest holders of BlackRock's IBIT ETF with over 30 million shares. This isn't retail FOMO, this is the deepest pool of capital in the world systematically allocating to Bitcoin. And this institutional bid creates a strong floor under the market that simply did not exist in the previous cycle. And this backdrop has led to some incredibly bullish forecasts from major analysts. Marshall Beard, the CEO of Gemini, and Tom Lee of Fundstrat are both calling for Bitcoin to hit $150,000 by the end of the year. Meanwhile, analysts at Bernstein have raised their target to $200,000 for the same period. And finally, this all sets the stage for a potential altcoin season. As Bitcoin stabilizes and grinds higher on the back of institutional flows and easier money, capital begins to look for higher returns further down the risk curve. And we're already seeing signs of this. The Altcoin Season Index recently hit 80, its highest level of 2025, signaling that the majority of large-cap altcoins are now outperforming Bitcoin. But before you go all in based on this bullish narrative, it is critical that we look at the other side of the coin. What could go wrong? Well, the primary risk is what we call the correlation trap. Over the past year, Bitcoin's correlation with the Nasdaq 100 index has reached as high as 87%. In simple terms, Bitcoin is trading less like a digital gold and more like a high beta tech stock. And this is a double-edged sword. It's great when risk assets are rallying, but it means that if the broader stock market corrects, Bitcoin will likely fall with it, and probably even harder. And the safe haven narrative is being seriously questioned. The second, and perhaps most significant risk, is the stagflation nightmare. If economic growth continues to slow while inflation remains stubbornly high, the Fed will be trapped. Cutting rates would risk fueling inflation, while holding or hiking rates would risk crashing the economy and the jobs market. This is the worst-case scenario for risk assets. In a stagflationary environment, corporate earnings would get crushed and investor sentiment would sour. Meanwhile, Bitcoin's high correlation with the Nasdaq means it would not be immune. And finally, there are always black swan risks lurking beneath the surface. The world is sitting on over $300 trillion in global debt, and within crypto itself, a new risk has emerged. Dozens of newly listed Bitcoin treasury companies that borrow in dollars to buy Bitcoin. The entire business model works only if Bitcoin's price keeps climbing. An unwind in these leveraged positions could cause some of these vehicles to sell their assets, creating the exact downward spiral that pushes prices lower. So, to recap, the Federal Reserve has officially pivoted, opening the door to an easier monetary policy for the rest of the year. Historically, this is a powerful tailwind for Bitcoin and the broader crypto market. Institutional adoption through ETFs is providing a structural bid that has never existed before. And the consensus view is that this combination could push Bitcoin to new all-time highs by early 2026. However, the risks are very real. Bitcoin's tight correlation with stocks makes it vulnerable to a broader market downturn. And the looming threat of stagflation could create a macro environment where there is simply nowhere for risk assets to hide. Our view is that the path of least resistance is now higher for crypto, but it will not be a straight line, so expect volatility. The key is to pair the technical picture with the fundamental backdrop we've discussed today. The odds are now leaning in favor of the bulls, but as always, risk management is paramount. Take care out there. Now, if you found that video useful, you'll enjoy our video on where the crypto market cycle top will be, and that's right over here. And if you're not subscribed to the channel yet, you can do that right now by hitting the subscribe button right over here. As always, thank you guys very much for watching, and I'll see you in the next video. Nick, over and out.